What's going on, my fellow wealth creators? Matty Ice here. In this video, I want to talk about how whole life insurance can literally save your life. And I'm going to give you some very specific examples, and we're going to talk about one specific rider that is usually included in a whole life insurance policy that I believe adds so much value to this policy, to this asset. It makes this asset so much more valuable. And it's often underlooked. It's often undervalued. It's often not even discussed, especially by people who don't like dividend paying whole life insurance. They say it's too expensive. You should buy term and invest difference. And we're going to get into that because here's the thing, guys, is we don't know what's going to happen in life. Like we don't know, like tomorrow we could find out that we have cancer or heart disease or whatever, right? Now, when we're younger, it's pretty unlikely, but there's still the possibility. And wouldn't it be nice to have an asset in place that will actually help us accelerate the wealth building process in our lives? I talk about that all on my channel all the time, how I use my own dividend paying whole life insurance policies to build wealth, okay? But what if we could have that and have incredible financial protection if the worst case scenario happens, okay? And it's interesting because people are always hell bent on making sure they have health insurance. Like if you don't have health insurance, oh my god, right? The world's coming to an end. Like we got to have health insurance, and you probably and we should, right? And usually when we're younger, it's to cover the catastrophic, like in case something catastrophic happens. But what are the chances of something catastrophic happening to you? It's pretty unlikely for the most part, particularly when it comes to diseases like chronic, critical, terminal illnesses, right? It's pretty unlikely, and yet people still have it, right? So if you're the type of person that says, oh, well, I don't need XYZ because that's not going to happen to me, well, then why do you have health insurance? If it's very unlikely that you're ever going to need your health insurance, at least when you're younger, then why do you have it? Well, you have it to protect yourself against the catastrophic in case it does happen, right? It's kind of foolish not to have health insurance. Well, this specific rider, it's called the accelerated death benefit rider that comes along, that's included with a dividend paying whole life insurance policy, helps cover the catastrophic event, God forbid, if you were to get sick, if you were to get diagnosed with a chronic, critical, terminal illness, all right, we would have access to significant financial resources, basically an acceleration of our death benefit to get the care that we want. And I'm going to give you a specific example right now. And then I want to show you my actual policy that one of my policies that I set up to show you how powerful this is. Like if I were to get sick tomorrow, God forbid, I would have access to a significant amount of money, far more than what I've put into the policy, right? That I could use for my own care, or if I just wanted to travel the world. Like it's an indemnity benefit, not a reimbursement benefit, right? It's a very big difference, okay? But I want to give you a couple of examples here really quick. All right, so one of my mentors, Chris Kirkpatrick, he runs the agency that I'm a part of, Life 180. He tells this story quite a bit on his channel. It's really, really inspiring. His father-in-law was diagnosed with, I believe it was stage 4 pancreatic cancer, basically a death sentence. His doctors gave him 3 months to live. And they said, I mean, we could do chemo, radiation, et cetera. It might extend you, maybe 2 or 3 months, but you're going to be pretty miserable. Probably don't want to do that. They basically said he's a dead man. Fortunately, he had a whole life insurance policy with this accelerated death benefit rider on it. So as soon as he was diagnosed with that terminal illness being your likely, the illness that you get is likely going to result in death within 12, sometimes 18 months. Every company is a little bit different. All right, but he's basically able to accelerate a very, very large portion of his death benefit at that point, which is what he did. So he immediately had access to hundreds of thousands of dollars that he could use for his own specific care. It allowed him to take control of his medical directive and pay for treatments that traditional health insurance would not pay for. All right, so and guess what he's doing today? He's alive today. I think it's like 4 or 5 years later. Plays golf, goes on the family trips and all that stuff. And his doctors gave him a 3-month life sentence. You should really call it a death sentence. All right, and but because of the alternative treatment that he was able to get, he is still alive today after being diagnosed with a cancer that has a very, very low survival rate. And the only reason he was able to do that is because he was able to accelerate the death benefit in his whole life policy. It literally saved his life. right? He accelerated the death benefit, so he had significant financial resources that he could allocate to these alternative treatments. He likely would not have been able to do that without his policy. All right, so I talk about this a lot on my channel, using dividend paying whole life insurance as a wealth building tool, which is great. Okay, but these are the types of things. What I'm talking about now, this accelerated death benefit rider. If you get diagnosed with a chronic critical terminal illness, okay, these are the types of things that are not often discussed and kind of swept under the rug and significantly undervalued. Oftentimes, they're not even part of the conversation with people who are against dividend paying whole life insurance and are proponents and advocates of buy term and invest a difference. Here's my question about that. Will your mutual fund, will your stock portfolio, will your index fund all of a sudden blossom into a massive income, a tax-free benefit that you can use to get alternative treatment if you were to get sick? No. What happens is, if you get sick and you need access to money, well, you need to sell off your assets, your mutual funds, your index funds, whatever's in your portfolio, in order to access that, assuming you're going to get alternative care outside of what health insurance is going to pay for. Okay, and even if you go down the traditional route and health insurance covers a certain amount of it, they probably won't cover 100%. There's probably going to be significant financial burden on you and your family, and you're going to need to sell off assets in order to make that happen. Well, what happens when you sell off assets? Well, you're going to pay taxes on it. Hopefully, you're selling at a gain and not a loss, right? And your mutual fund, your index funds are not going to blossom into more than what you've put into your portfolio, aside from any gains that you have in your portfolio, right? So I want to show you an example of this here really quick. This is like a massive benefit of these policies, and it's one of those like external rates of return that you get. Like, you can't really put an actual rate of return on this. Like, everybody's so hung up on the what kind of rate of return am I going to get in my whole life insurance policy? And look, that's important. Like, we should take that into consideration, but just accept that these things are going to net, after all expenses, 3.5%, 5% tax-free compound growth for the life of the policy, assuming you set it up with for high cash value. Depends on how you set it up in the company, etc. All right, but that's pretty good for a safe vehicle. We don't really need to dive into the internal rate of return much more. Like, how much more would you expect to get in your CD or savings accounts or your bond portfolio, right? Like, not much more. In fact, those things typically don't pay 3.5% to 5%. It's only recently, over the last couple of years, that they're close to that. These policies, even with interest rates at rock bottom, typically net 4 or 5%. All right, so okay, that's great. All right, we can see that on an illustration and get a pretty good idea of what it's going to do long term. But how do you put a rate of return on having access to hundreds of thousands of dollars tax-free to take control of your medical directive if you were to get sick? And if you think that if you're of the mindset that, oh, that's not going to happen to me, then my channel is not for you, because I'm just not of the mindset that we're going to go through life and nothing bad can ever happen. It absolutely can. And if I could build wealth, accelerate the wealth building process, and provide financial protection for myself and my family in case the worst case scenario does happen, I'm going to do that all day long and cross my fingers and do everything that I can to make sure I don't get sick. But it does happen, guys. And I'm going to give you another example here in a minute. But let me show you the power of this policy here. And actually, you know what? I want to go into that example first, because I think this is a really important part. The numbers are great to look at. We'll do that in a second. All right. I'm going to show you how much more I get access to than what I put into the policy if I were to get diagnosed with a really bad illness. Okay. But if you think this stuff can't happen to you, man, I see this quite a bit, unfortunately. And the data shows, at least recently, that cancer rates, diabetes, things like that, are accelerating pretty drastically. It's a little scary in young people. So, again, not to say that it will happen, but it could. And what happens if it does? Are you prepared? Right? And unfortunately, I saw this. It was a couple of months ago. An acquaintance of mine, her husband was diagnosed with non-Hodgkin's lymphoma, which fortunately has a pretty good survival rate. All right, but he's my age. I think he's a little bit older. I'm almost 37. I think he's a couple years older than me, and he has cancer. Like, do we really think, are we sitting around at 35, 40 years old expecting to get cancer? Like, is that something that we worry about? No, it's usually something we worry about when we get much older, past, 50, 60. It should be like, around 70, 80 that we should really be concerned about that. Not at 35, 40 years old. All right. But he was diagnosed with it, unfortunately. And from what I understand, so far he's doing good. But from what I can tell, he did not have a policy in place. There's lots of fundraisers that are taking place to help them through this, which is great. I love to see that. I love to see the community coming together and supporting each other. That's great. But ask yourself this: what if he had a policy like what I'm about to show you that he was contributing to that would blossom into a significant amount of money that would allow him to accelerate his death benefit and give him the financial resources to get the treatment at worst case scenario to make sure that the family doesn't go bankrupt? It's really expensive to get sick, guys. And so if you think it can't happen to you, think again. It absolutely can. And it also, again, if that's the case, if that's your mindset, then what do you have health insurance for? Like, everybody usually has health insurance, which you should. You should have some type of health coverage. Why? It's to, when you're younger, it's to protect against the catastrophic, typically, right? Well, if you're of the mindset, oh, that's not going to happen to me, then why do you have health insurance, right? You have it because of the possibility of something catastrophic happening. One of those catastrophic things is getting sick. You just don't know, guys. We just don't know exactly if, when that's going to happen. And in my opinion, my goal anyways is to be prepared, be as prepared as possible for the worst case scenario and hope for the best. All right, hope for the best, prepare for the worst. All right, and that's what we're doing. And again, we're building wealth in a very safe way with these policies at the same time. All right, so let me show you the power of this. All right, let's go through my policy. This is one of my policies. I have two right now, so I would have access to even more than this, right? Because you can accelerate multiple like however many policies you have if you get diagnosed with this. All right, so this is my policy right here. Here's my name. All right, I got this. I was approved when I was 35, so I'm in my second year right now. I just paid my second premium. What was it? October or December? I don't remember. I think it was October. Whatever. All right, so this is my policy. I'm funding it pretty aggressively. All right, let's scroll down I just wanted to show you guys that this is my policy. Okay, let's go to the accelerated death benefit plus report. So what this is basically if I get diagnosed with a chronic, critical, they call it in this one, it's specified medical condition. It shows that in the like what specific conditions there are. Usually it's going to be some type of critical illness, heart disease, sometimes diabetes, some types of cancer, etc. And then terminal illness. And this is like if I get diagnosed with something that's expected to result in death within 12 months. All right. And it's showing, depending on what the illness is that I'm diagnosed with, how much I can advance my death benefit. Okay. So let's say I'm 5 years in at, I hit 40 years old. Okay. Let's say I get a chronic illness, something that results in it limits my ability to perform daily activities of living. Okay. Max lumps, so I could do a lump sum. You can also get periodic payments, but let's just stick with the lump sum for now, keep it simple. All right, in year 5, I could advance upwards of almost $384,000. Now, how much have I put into the policy at this point? Well, if we go back and we look at year 5 and we go to my cumulative premium amount, at the end of by year 5, I will have put $220,000 into the policy. Okay. But all of a sudden, if I were to get diagnosed with a chronic illness, I now have almost 384,000, and this is just one policy. That's not even included. This is not even including my second policy. Okay, but I have $384,000 I have access to now for my own medical directive. All right, to take control of my healthcare, get alternative treatments, whatever. Okay, maybe it's physical therapy, stuff that health insurance won't pay for. All right, it's going to protect me from basically going bankrupt. And here's the thing: I still have, if we go back to the accelerated death benefit rider here, I still have a remaining death benefit afterwards. So even after this, after accelerating my death benefit, I still have death benefit left over. God forbid, I pass away because of it. I still have a death benefit that gets passed on to my loved ones, income tax free. All right, so that they have financial resources. Okay, here's like if we look at the terminal illness, like if I was diagnosed with pancreatic cancer, like Chris Kirkpatrick's father-in-law, and I was given a 90-day life sentence, a death sentence, whatever. It's pretty scary. That's pretty scary stuff. I would have even more. I would have 464,000, almost 465,000 that I could use. Here's the thing, either for my healthcare, or let's say, you know what? I don't have much time left. I want to do everything I possibly can. I want to I want to be Mr. Bucket List right now. All right. I want to cross things off that I've always wanted to do. I want to spend as much time with my family. I want to go on these awesome family trips. You could do that because again, this accelerated death benefit is indemnity based, not reimbursement. So you can use the money for whatever you want. And I was listening to Logan, my apologies, Logan, I forgot your last name, but over at Hazeltine LLC, absolutely check his channel out. Really, really good stuff. He was telling a story about, I believe it was one of his clients, or maybe a client of somebody else he knew, where she was diagnosed with, I believe it was cancer. She had 6 months to live. That's at least what the doctors gave her. Maybe it's 3 months, but not a very long time to live. And what she decided to do, instead of getting like alternative treatments and stuff like that, I'm sure she did something to make herself as comfortable as possible, but she decided to travel the world. She decided to go on lots of family vacations and create all these memories and stuff like that. And that was her choice. That's the powerful thing here, guys, is it was all in her control. You can get alternative treatment. You can go travel the world. Whatever you want to do, you are able to do it. And for me, this is such a powerful feature that gives a rate of return that cannot be mathematically determined, in my opinion. Like what value do you put on, like what rate of return would you need to get in order to have access to something like this? And keep in mind, our money is growing every single year, compound tax-free compound growth, the life of the policy. So hopefully we never need this. Okay, but the fact that we have it, how much peace of mind does that bring? Oh my goodness! Like financially protecting ourselves in case if in the event that the worst case scenario happens and we get sick, man, we have access to significant financial resources above and beyond what we've put into the asset in order to get the treatment that we want. Mutual funds and index funds don't do that. The stock market doesn't do that. No, I'm not saying don't invest in the stock market. I'm not saying to not invest in mutual funds and index funds and all that. I'm saying we should do both. Screw this buy term and invest the difference crap. All right. How about we do both? How about we take a portion of our bond portfolio? All right. Because with buy term and invest the difference, I don't think most people are putting all of their money into the stock market. Usually the portfolio is balanced with stocks, mutual funds, whatever, higher risk assets, and bonds. Well, I just did a video about why dividend paying whole life insurance is far superior to bonds and why it could be probably a good idea to reallocate at least a portion of the bond portion of your portfolio into dividend paying whole life insurance. And all of a sudden we're doing both. We have higher risk assets, high reward assets, mutual funds, index funds. I'm not a fan of the stock market, but if that's what you want to do, fine. All right, so you have your stock portfolio, and all you're doing is reallocating some of your bond portfolio to dividend paying whole life insurance. Now you have both. Why is it either or? Why is it whole life insurance or the stock market? Let's do both, guys. Let's break out of this. Let's have a paradigm shift here. Let's break out of this traditional financial wisdom that honestly is just really not serving us in the best way, at least in my opinion, and based off what I've seen. All right, let's cover all of our bases here. Let's think holistically. Let's take a more holistic approach to our personal finances and explore how these different financial vehicles actually work and how they could benefit us. And let's see how to put it all in place, because you can absolutely do it, guys. And so with that, I think I'll go ahead and wrap up. Let me just check my notes here, make sure I didn't miss anything. Yeah, I think I covered everything. So anyways, that's my rant for the day. But it's not even really a rant. This is real life, guys. These things happen, and these policies just provide so many benefits. You know, that's like it's a multi-dimensional financial vehicle, right? It's kind of like that's why they call it the Swiss Army knife of financial vehicles, because it solves so many problems with one asset. All right, we're getting the safe compound growth. We have liquidity to build wealth, right? I talk about this on my channel all the time, where I borrow against my cash value, I lend it out on real estate, I'm making money twice now. We get massive tax advantages. We protect our loved ones financially in case we pass away. We have long-term care protection, even if we're not old. And if we get sick, unfortunately, God forbid, when we're younger, we have that protection as well. So like, there's so many benefits that we get just from $1, from the same dollar. right? So that's why I'm a huge fan of these policies, guys. With that said, make sure you're working with the right agent who knows how to set these things up, preferably an agent that has their own policies under like actually implements the stuff in their own lives. So if you want to have a conversation about that, I'll link some resources down below. But I hope this helps, guys. To your success, Matty Ice is out, and I'll see you in the next one.